Hey everyone, Brandon here. Let's talk about something that gets every real estate investor excited, making money. For years, the big buzzword in our world has been cash flow. You've heard it a million times. How much cash flow does it make? It's a great question, and positive cash flow is absolutely essential. It's the lifeblood that keeps your property running month after month, paying the bills and putting a little extra cash in your pocket. But what if I told you that focusing on cash flow is like looking at a football game through a tiny peephole? You might see the quarterback throw the ball, but you miss the receiver catching it for a touchdown. You're missing the bigger picture. Real estate investing is a multifaceted game, and cash flow is just one player on the field. Relying on it alone can cause you to pass up on incredible deals or misunderstand the true power of your investments. I've seen investors walk away from properties with massive potential simply because the day one cash flow wasn't spectacular. They were leaving a fortune on the table. Think about it this way. Cash flow is what your property pays you. But what about what your property earns you? There's a huge difference. Today we're going to pull back the curtain and look at the whole game. We're going to talk about a concept I call total profit. This is the metric that truly reveals how much money you're actually making from your rental properties. So, what exactly is this total profit I'm talking about? Put simply, total profit is the complete financial return you get from a rental property over a specific period, usually 1 year. It's not just the cash left over after paying the bills. It's the sum of all the financial benefits your property provides, both the visible and the invisible. Think of it as the ultimate report card for your investment. It tells you the full story, not just a single chapter. This comprehensive view helps you understand the true performance of your asset. Let's break it down. Total profit includes your net operating income, or NOI, which is all your rental income minus all your operating expenses, before the mortgage. But it goes further. It also includes the portion of your mortgage payment that pays down the principal, the appreciation of the property's value, and the tax benefits you receive from owning the property. The key difference between total profit and simpler metrics like cash flow is perspective. Cash flow is about short-term survival. It asks, is this property paying for itself right now? Total profit is about long-term wealth creation. It asks, how much richer did this property make me this year? Both questions are important, but only the second one reveals the true power of holding real estate. It shifts your mindset from being a bill payer to being a wealth builder. This is why understanding total profit is a game changer. To really grasp total profit, you need to understand the 4 main ways a rental property makes you money. I like to call these the 4 pillars of real estate wealth. The first and most obvious is cash flow. As we've discussed, this is the money left in your pocket each month after you've collected all the rent and paid all the operating expenses, including your mortgage payment. It's the profit you can see and touch. The second pillar is appreciation. This is the increase in your property's value over time. While you can't spend it until you sell or refinance, it's a massive wealth builder working for you 24/7. Appreciation happens in 2 ways. Natural market appreciation, where the entire market goes up, and forced appreciation, where you actively improve the property to increase its value. The third pillar is the mortgage paydown, also known as loan amortization. This one is my favorite because it's practically invisible, yet so powerful. Every single month, when your tenant pays rent, a portion of that money goes toward your mortgage payment. And a portion of that mortgage payment pays down the principal balance of your loan. In simple terms, your tenants are buying the property for you, little by little. The fourth and final pillar is the tax benefits. The government loves real estate investors and offers some incredible tax advantages. The biggest of these is depreciation, which is a phantom expense. The IRS lets you deduct a portion of your property's value from your taxable income each year to account for wear and tear, even if your property is actually going up in value. This deduction can significantly lower your tax bill, saving you thousands of dollars. Alright, theory is great, but let's make this real. Let's walk through an example with some easy numbers so you can see how this works in practice. Imagine you buy a duplex for $300,000. You put 20% down, which is $60,000, and get a loan for the remaining $240,000 at a 6% interest rate for 30 years. Your monthly mortgage payment, principal and interest, comes out to be about $1,440. Each unit in the duplex rents for $1,500 per month, giving you a total gross rental income of $3,000 per month, or $36,000 per year. Of course, you have expenses. Let's budget for those. We'll estimate property taxes at $300 per month, insurance at $100 per month, and we'll set aside 10% for vacancies. That's $300 per month. 10% for repairs and maintenance. Again, $300 per month. And 5% for capital expenditures, like a new roof or water heater down the road. That's $150 per month. So your total monthly operating expenses are $1,150. To find our monthly cash flow, we take our total income, $3,000, and subtract our operating expenses, $1,150, and our mortgage payment, $1,440. So, $3,000 minus $1,150 minus $1,440 equals $410 per month. That's $4,920 per year in cash flow. Not bad at all. Many investors would stop here, happy with their $410 a month. But we're not going to stop there, are we? We are total profit investors. We know there's more to the story. That $410 per month is just the first piece of the puzzle. It's the tip of the iceberg. Let's calculate the total profit for our duplex in its first year. We already have the first component. The annual cash flow is $4,920. Now for pillar number 2, mortgage paydown. In the first year of a $240,000 loan at 6%, you'll pay roughly $17,280 in total mortgage payments. A quick look at an amortization schedule shows that about $2,950 of that amount went directly to paying down your loan principal. Next up is pillar number 3, appreciation. Real estate values tend to go up over the long term. Let's be conservative and assume a modest 3% appreciation rate for the year. On a $300,000 property, a 3% increase is $9,000. Your duplex is now worth $309,000 on paper, and your net worth just grew by another $9,000. Finally, let's look at the fourth pillar, tax savings from depreciation. The IRS allows you to depreciate the value of the building, not the land, over 27.5 years. Let's say the building value is $250,000 of the total $300,000 purchase price. Dividing $250,000 by 27.5 gives you an annual depreciation deduction of about $9,090. If you're in a 24% tax bracket, this deduction saves you $2,181 in taxes. Now, let's add it all up to find our total profit for the year. We have $4,920 in cash flow, plus $2,950 in mortgage paydown, plus $9,000 in appreciation, plus $2,181 in tax savings. The grand total is $18,951. Think about that. While the cash flow investor saw a property making just under $5,000 a year, the total profit investor sees it's actually generating nearly $19,000 in total wealth. That's almost 4 times more. So you see how powerful understanding total profit is. The question now is, how can you increase it? The beautiful thing is that you have control over every pillar of wealth. To boost cash flow, you can increase rents to match the market rate, or you can decrease expenses by shopping for better insurance, appealing your property taxes, or implementing water-saving fixtures to lower utility bills. You can also add income streams like coin-operated laundry or charging for storage space. To maximize appreciation, you need to focus on forcing it. Don't just rely on the market. You can add value through strategic renovations. Updating kitchens and bathrooms, improving curb appeal with new landscaping, or adding a bedroom can dramatically increase what your property is worth. This is the buy, rehab, rent, refinance, repeat strategy in action. By making smart, cost-effective improvements, you are actively manufacturing equity and boosting that appreciation pillar far beyond the market average. What about the mortgage paydown and tax benefits? You can influence these too. To accelerate your mortgage paydown, you could consider a 15-year loan instead of a 30-year one if the numbers still work for cash flow. For taxes, make sure you are working with a great CPA who specializes in real estate. They can help you maximize your deductions, take advantage of every tax law, and ensure you're keeping as much of your hard-earned money as legally possible. Ultimately, winning at real estate investing comes down to making informed decisions. By looking beyond simple cash flow and embracing the concept of total profit, you gain a massive competitive advantage. You'll analyze deals more accurately, identify hidden opportunities, and build wealth faster than you ever thought possible. This isn't just about spreadsheets and numbers. It's about building a future of financial freedom for yourself and your family. So go out there, analyze deals with this new perspective, and start building your own real estate empire. You can do this.